What if I tell you that the right loan starts with the right question? If you need a loan, you want to compare it. But before you start comparing, you need to define the purpose of your loan. You need to define your repayment source. You need to understand the risk the business can actually support. Okay? Today, we'll be looking at the types of loan that is best for you and your business. Are you about to get that loan from your creditor? Number one, identify the purpose at which you want to collect this loan. You need to separate operating needs, productive assets, property needs, growth needs from business needs. If you muzzle all these things up, it might be a problem for you in the future. Ask yourself this question: what is your repayment source? How are you going to be making this payment? Survey shows that 90% of people, average literal people, collect loan not knowing how to pay. So repayment source is always a key. You need to understand your business capacity. Your business, is in the capacity of, let's say, 100 million, and you are looking for a loan of 500 million. To do what? Your business can't take it. You only waste those funds. Then you need to understand your kind of acceptable risk. What risk is acceptable for you that your business can comfortably absorb? If you're a risk-prone person, you want to take risks that are way above the business. If you're a risk-averse person, you would like to put the business first before you go into taking such risk. So loan, you can't rule it away from risk. It's mostly risky. I don't want to talk about lending sharks that we have. They've exploited quite a lot of people that people don't know how to get out of the group. All you just want to do is collect loan at the same time. They come with juicy offer. Some will tell you, if you collect 100,000, your interest is 3 million. All these are just a bunch of lies. So you need to read the caveat behind these loans before you start taking these loans. Before we start, I want you to know that eligibility varies by lender and jurisdiction. A strong application tells one current repayment story. It's different from the other. That's why you need to be careful. You need to be very, very cautious before you jump into any loan. Let's start with term loan. What is a term loan? A term loan is a fixed amount to repay over a defined schedule, best for store fit-outs, expansion projects, refinancing, and other investment with a clear budget and useful life. Okay? Over time, repayment needs to be made. And when you are making this repayment, it needs to be short in nature. It is term, it has a fixed or definite date. Quite a lot of loans fit into this category, but the difference between this is that it is fixed. You know what it's for, you know the specific tenor, you know when it will end, you know when you are starting, you have fixed repayment in nature, and at the end of it, it's all clear to all parties involved that this loan, it's as been collected, needs to be repaid over that certain period of time. Then apart from the term loan, let's look at lines of credit. What are lines of credit? Lines of credit are revolving facility that can be drawn, repaid, and potentially withdrawn, best for timing gaps between cash inflow and outflow, senior inventory, payroll, and recurring short-term needs. Okay, let me give you an example. Majority of the credit card you use have credit lines on it. They've given you that credit line. You can decide to exhaust it, you can decide to use it halfway. The bottom line is you have such credit limits. In some cases, it's revolving, in some cases, it's one stop, and in some cases, it could just be increasing, which means we're giving you a line of credit for 100,000, and maybe after you've exhausted this, it can be increased to 200. Okay, and in your case, you can be on a facility and you want to have additional funds to it, which means you have a limit of a certain amount. You can't draw more than the credit limit line that you have been given. That's how it works in developed countries where you have credit cards and they keep spending from that credit card from time to time. I think it's a feature that is quietly growing in developing countries. The other kind of loan we'll look at is the asset financing. In some cases for finance companies known as lease financing. So what is asset financing all about in the scope of microfinance bank? This is a productive asset that involves borrowing structured around equipment, vehicles, machinery, or technology. It is best for assets expected to generate revenue or efficiency over several years. When we say to generate efficiency over several years, we are talking about assets that are not income generating but generate efficiency. Generator, okay, office equipment. You can, even as small as stapler can be counted to that. Now we look at those that are income generating. We look at lease operations. We look at vehicles. Okay, you look at plant and machineries. These are income generating because if you lease, maybe on a financial lease or operational lease, whichever one, operational lease, you bear the costs while the lease agreement is still on, while financial lease, the other party bears the cost. Okay, so it's just one to the other, but we're not diving into that today. So it works in a way that the asset being purchased is meant to generate income or efficient and operational use. That's one kind of loan that a lot of people that are prudent in spending, they just want to get a particular equipment, they don't need your money. And there are terms and conditions attached to this too. Majority of the time, we have equity contributions to it, ranging from 20 to 40%, and some conditions like ownership before it is, before the payment has been crystallized. Let's talk about invoice financing. This is one kind of loan that a lot of microfinance are gradually getting their hands into bit by bit that I've seen lately. Now, what is invoice financing? Invoice financing is used unpaid business-to-business invoice as the primary funding support, best for businesses with creditworthy B2B customer and a recurring gap between delivery and collection. What are we talking about here? Okay, let's say your business is expecting payment from a company and you need just quick funds to finance your other business, and you approach a microfinance bank, and the microfinance bank or the lending institution gets a hold of your payment document. They are satisfied with what they've seen. All they are just waiting for is for you to receive funds. They discount what they are giving to you, and you pay interest on that discount figure, which is personally fine. Okay, so it's a business to business thing where I'm going to give you money based on the fact that you're expecting money, and I'm believing that I can make something out of it while you're expecting that. Usually short term period, a month, 45 days, 60 days, max 90 days, but I guess I fear they hardly get to 90 days. So that works out as another kind of business, another kind of loans that the company is getting to. Let's look at commercial or property finance. Okay. Now, what do we mean by property or corporate finance? This is secured financing for businesses, property purchases, refinancing, construction, or improvement, which is also best for owners occupied premises or clearly underwritten commercial property projects. Always large in scope. It's always capital intensive in nature. Their funds are way more than the usual retail loan or SME loan is always in millions. The assessment process are always cumbersome and tedious and precarious. You need to be careful. They are for large or commercial purposes. I think developers fall into this development, and developers for both of them, that development stage and true developers fall into this stage where they need funds to develop a particular property. At times they go to banks, at times they go to institutions to have these funds for them so that they can use it to develop their capital projects. So this is another kind of loans that is out there that people are really interested in. A lot of people don't really talk about commercial development backed finances. What do you mean by development backed bank finances? This is government backed development bank guarantee or targeted program finance. Eligible businesses that need working capital, equipment, property, or growth finance that may be harder to obtain conventionally. Okay, now let me give you instances. In Nigeria, we have the infrastructure bank that deals on financing infrastructure projects. We have development bank that seems to focus on businesses that are developmental in nature. We also have institutions along this line that are just centric focus. All they do is to focus on businesses that are that builds economy, that reduces inflation, increases our domestic GDP, and makes the economic more viable to trading. Okay, so they focus on those that are running this project and tend to finance the businesses that they are doing. And it's a very good source. A lot of us don't really focus on some of these institutions. Some of them do give a lot of grants. I've come across a lot of them. You can drop a comment for me, and I think I'll check into my account and drop some links for you. I think I actually posted, you check the description box below, and I think I can have it up here. Okay, yes, these are some institutions that are actually giving out grants now based on infrastructure development projects. So just make sure you visit them. Just subscribe to my video. You'll see a lot of them there. 7 funding, 3 funding. It's just there. Just take your time and have a good feel on where you can get free funding for your business apart from loans. Then we now have the retail loans, the SME loans. These are for everybody, small businesses. You can get this through lending institution, microfinance bank, even some commercial bank are interested in giving loans to retail market. So it's for everybody as long as you meet the requirement. Some are interested in you getting them guarantors, not collateral, while some are interested in actually having fixed collateral depending on the amount. Assessment is being carried out for such loans, no matter how small. You are always precarious and careful too, because these funds are not free money. When you collect them, you need to pay back. Another loan that fall into the category is payroll lending. Payroll lending could be private or public sector. You are working in a government institution, that's not public. You work in a private institution, like banks and other financial institutions, other commercial institutions, it's private. So loans are being, split into two under the payroll lending system. And under the payroll lending system, as a staff, you can actually walk up to a commercial bank and tell them, oh, I need loan. They get some request for pay slip, some request for your salary breakdown, some request for your checks, some request for your statement of account, depending on what they want. Some will just bluntly ask you to get me a guarantor, while some are not interested. Okay? The likes that I know of, I know Red Money doesn't ask you to get a guarantor. Carbon doesn't ask you to get a guarantor, but if you walk straight up into a conventional brick and mortar or a hybrid microfinance institution, they will likely tell you to get a guarantor for your loans. Now let's talk about the eligibility. What eligibility criteria do they look for? One, anybody that's going to give you a loan needs to understand your cash flow. How does your cash flow work? 3 documents that every customer has that they don't know they have. Personally, I can walk up to a customer if I want to conduct my assessment and tell you, oh, madam, how you doing? You want to know? No problem. How much have you sold today? And he quietly tells me, oh, I've sold between this morning and 1 o'clock, I've sold 100,000. That money actually goes to the balance sheet, the customer's balance sheet. The customer has a balance sheet, doesn't know, because that is the cash in hand. And you go out to ask the customer again and say, oh, what do you have in your bank? Do you have any money in your bank? And he tells you yes. That automatically goes to your cash in bank in your balance sheet. Okay? Then you're asking the customer, are you on any loan? He says yes. I got a 30,000 from a money lender, and I'm running a loan with a commercial bank. That's quite a large amount. Let's say 1 million. So, and that 1 million will take 1 year, while the loan from the credit lender will take you, let's say, max of 1 month. The loan you got from the money lender for 1 month is a short-term loan, so it goes to the column of a short-term column in the balance sheet, the customer's balance sheet. Then the long-term loan, which is 1 million, which is going to take up like here, goes to the customer's balance sheet as a long-term loan. The other thing that I'll be looking for, asking you, is if you are selling goods, I'll ask you, the goods you have in your shop, what's it worth? That is your inventory, also going to the balance sheet. Okay, then we have your prepayment. Okay, your prepayment are funds that have been paid. Okay, that's of goods you are expecting but you have not got, so it forms it forms asset to you that you're expecting, so it forms asset, part of your asset. Okay, then if you've gotten receivables and those receivables are money you've collected for goods yet undelivered, that's a liability. The book that I've just given to you now is a customer's balance sheet. So if you don't understand your business, then you don't have a business assessing loan. The same way I've given analysis of this is the same way I'm going to do analysis for a customer's income statement. Okay? A customer has sales record. The sales for the day is what you are going to use. It's the first thing you'll be recording in the customer's income statement. You have to understand the gross margin at which that customer sells. And the only way you can get the gross margin is for you to, first of all, get the margin. What margin does the customer add to his purchase figure to give him his sales? So your purchases from your sales, you are going to get your cost of goods sold. Now, if you now deduct all your expenses, okay, from your gross profit, it's going to be giving you your net profit. But along the line, you still have to add if you have other sources of income to it or other expenses. Now, the way it works for a customer's income statement is that salaries earned from a family member, direct family member, or the husband is added to the profit and loss. I'm breaking down these things so that you will understand how you collect loan or why you need to collect loan at any point in time. Then I now break it down to the cash flow level. You need to understand your cash flow. Currently, I have a cash flow template that I created. Just type send to me in the description box with your email address and I'll make sure I send it to you. You as a person, anybody can use it. It helps you to monitor the inflow and outflow of cash substances that you have daily with you. Okay, so this is very, very important that you have. As an individual, you must understand that you have a balance sheet, you have an income statement, and you also have a cash flow. So if you understand all these things, trust me, you'll know if you really want a loan or not. And among the principles of microfinance, we have 11 principles of microfinance, and I love one. Most is not always appropriate, but everybody wants to jump on it because there's a bandwagon moving and you want to jump on the bandwagon. Now, finally, for today, I'm going to be telling you what you actually need. This is a practical decision part. You have to think twice. We have a lot of loan sharks out there. They are just ready to tear you to pieces. So once you fall into a trap, it's going to be a big one for you. Number one, you need to define the purpose and amount. What do you need? I gave you 3 things you need to have before you understand if you really need that loan. Understand your balance sheet. What are your assets? What are your liabilities? What do you have in case you can be able to make payments? Okay. In your business, are you making income? In the salary you're expecting, will there be a disposable household income that you can use to take care of these loans? Is something that is key that you need to have. So define the purpose of why you want to collect that loan and define the amounts of loan you want to carry. Then another thing you should do is you need to shortlist structures. What do I mean by shortlist structure? You need to compare term loans, compare asset loan. In most cases, the rate differs. And from my experience so far, I've seen that some asset finance are a little bit more cheaper. So if you actually want to get loan to buy an asset, why don't you just request for an asset loan instead of getting the money that may come at a higher cost to get the asset? So you need to define the purpose and the amount, and you need to shortly structure. Okay, you need to compare and negotiate which one works for you. Logically, if you are assessing a higher loan, it should come down with lower interest, because when you get a higher loan and you are trying to pay back, the interest is always heavy and it's burdensome. So I know some microfinance institution will tell you, no, our rate is fixed. Believe me, if you're a good customer, it gets to a stage that you can start negotiating your rates. You need to identify the repayment source. Where are you going to get this payment from? If you're a business person, the first place you can get your repayment source is from your household disposable income. That's after you've gotten your sales, you've minus your cost of goods sold, you've gotten your gross profit, you've removed all your operational expenses, you have your disposable income after you've added maybe a family income if it's available, or you deduct other expenses if available. Then you now add that money, you multiply it by your risk buffer. What's your risk buffer? Let's say you make 100,000 extra at the end of all your business month, or after you work, what you have is just 100,000 on you after your expenses. Now, get a fraction of that money and keep, because you are not going to be using the whole of that money to make loan repayments. You can't have 100,000 at hand at the end of the month and say you won't start making repayment of 100,000 monthly. That would be stupid. So what you will do is, you say, I'm taking out maybe 30, 40, or 50, depending on how you take it, depending on what's comfortable for you, and say, okay, this is the amount I'll be using to make repayment for my loan. It works best for you. So if you do this, you are not going to be paying loan and be stranded. That's why your loan always default, because you calculate with your disposable income without taking cognizance of other unforeseen circumstances. And this is why you should understand why you are holding money. The Keynesian theory gave us 3 reasons why we hold money: precautionary, transactive, and speculative. Okay, so if you understand these things, you know that loan is not always appropriate. At times, savings can even take you there. And this is what a lot of poor people need. Active poor, they need savings more. That's why you see a Susu thriving. That's why you see Ajo people thriving. That's why you see thrift collectors thriving, because they go to this market and they keep mopping up funds. They are doing way better in deposit mobilization, even way than Microfinance bank, and in some banks in some cases. You need to test downsides. Have you collected loan before? Was it enjoyable? If it's not enjoyable for you, please get yourself out. Only collect loan when you have a business, when you are working. Yes, I know some unforeseen circumstances happen. That's why the likes of GT Bank will charge you for insurance, because they will insure the loan they are giving to you, and any wise bank would want to do that anyway. Then learn to borrow in stages. Test your borrowing. How much do I need? I need 100,000. What if I get an 80? How will it work out? Test your borrowing. And if you eventually even get 100 in the first stage, and it's like too heavy for you, you can come down. The norm we have is that if somebody collects 100,000, you want to graduate immediately. It doesn't always work like that. The dynamics of your business model might not work that way. It could be a seasonal approach that will have an adverse effect on your business. Okay, in your boom time, you can collect as much as you want to run, as much as that business size takes. And when you're out of season, you get less. Loan is good if you are having a good business. You just don't jump to collect loan when it's not necessary. So I advise you, don't be a victim of loan sharks. You need to be careful. They are everywhere. And remember, I said, loan is not always appropriate. If you've enjoyed this video, kindly subscribe and follow us for more details. This is the only time and the only way you support us in what we are doing. This is more like an hobby. So make us proud. Kindly hit the subscription link and click the notification button. My name is Henry Onyema. Nice having you on this podcast today.